S&P 500 as we get ready to trade September week 3 with monthly OPEX coming up this week. 2 expirations for the options for Friday because of that, as you know. Also really important this week, maybe even more important than monthly OPEX, is that we have the CPI data on Tuesday pre-market and PPI data on Wednesday pre-market, and those will be big market movers. Let's start off looking at a chart of the S&P 500, the daily, more simplified chart, where we focus on the forks and the simple moving averages. And we have a new bear fork since we had such an extreme low this summer and an extreme high. Time to throw a fork on that. And as you can see, we came down and came nowhere near hitting our median line of this new fork, but we also came nowhere near breaking our longer standing bull fork as well. If we were to fall further below the current September low that we just set this week, it would take as of Monday, a break of 38.69 in order to break down below this fork. And if we were to break down below this fork, maybe we would go after the median line down here at 37.30. This is a falling level. This is a rising level. On the other hand, in order to break out of the sell-off that we have been in since hitting our August high, our bounce high off of the 2022 low, we would get up into the 4200s and about 42.13 as of Monday, and a falling level to break out of this bearish pattern. And just above that would be the 2022 halfway back, a major important level. You can see how our high in August was a look above this and fail. And then of course the 200-day, which is exactly where the August high came to and then rolled over from. So if we were to get a good reaction to the CPI data on Tuesday morning, it's very easy for us to make it to 4,200 and break out of this whole bearish pattern. But of course, if we do break out of this bearish pattern, make a lower high, and fail again at the 200-day, that's probably a recipe for us to fall all the way back down here and maybe test that median line, if not fully test our low for 2022. Let's take a look at the roadmap, a more detailed version of this same chart. You can see how close we are to that 20-day. If we were to continue on this rally Monday morning and continue to add points on the board ahead of the CPI data, maybe painting the tape here before getting into some puts for a pullback, if there's a bad reaction to that data Tuesday morning, then we would see a breakout over the 20-day, and maybe we would go after and challenge this gap here that started off from the August 26th open. We'll see. You know, if that's the way things go, let's think about taking some profits here and waiting for that CPI data. The worst thing that can happen is that you miss this breakout to the 200-day simple moving average. You could always just wait and see what happens here and then buy the breakout above the 200-day if that's the way that plays out. Of course, if you have some good profits from this rally and you wanted to modestly buy some puts in case there's a bad reaction to the CPI data on Tuesday morning and we open up in a sell-off, make sure you're just using some profits that you can lose 100% of. You know, say if you have made a triple on some $5 calls, maybe you look for a $5 or an $8 put at half size of what you played in the calls, and then if we get that sell-off reaction, you're playing that without losing all of the money that you've made so far on this rally. So something to think about there. Hope that makes sense. If not, you can always direct message me on Twitter and in the private account, and I'll explain what I'm talking about in a little more detail. If we were to fall out of this rally starting on Monday, if the profit taking has already begun, we're looking directly at the 100 and the 50-day simple moving averages, which closed almost in a bullish cross on Friday. So if we were to come out and break down below this set of simple moving averages, obviously we're going to fill the gap back to Thursday's close and test the 10-day and the summer halfway back down here at 39.81. Finally, let's take a look at Apple. Apple has been a great source of an indicator for us for the S&P 500. You can see that the sell-off on Apple held directly at its bull fork median line. Let me show you the version of this chart backed out to show you the origin of this fork. This bull fork comes from this high that was made 2 years ago into September earnings, where it missed its numbers and sold off drastically into the end of September, only to be the source of where you could buy the stock and ride it all the way up to its new and latest all-time high at 182.94, set in January of this year. And you can see that that fork was formed, and the low that has been made so far for the month of September held this bull fork median line just perfectly. So if that's any indication of the overall market, since Apple has hands in so many different sectors of the market now, beyond the fact that it makes its own chips, the fact that it has retail stores, and it has its own credit card, it's a great overall indicator for the economy. It held this median line. It's working its way back to its 50-day and its 10-day. We need to see Apple strong on Monday, breaking out over these sets of SMAs and making it to its 200-day and possibly breaking out over that. If one or the other isn't happening, if S&P 500 is selling off while Apple is rallying, I wouldn't really believe the sell-off in the S&P, and vice versa. If the S&P is rallying while Apple is selling, I wouldn't really believe the rally in the S&P. Hope that makes sense. They need to be working in tandem and going in the same direction as each other. Okay, that's it. I hope this video helped you out and gave you some good information to start the week. Have a great rest of your Sunday. As always, good luck and good trading.